You are about 5 years into a 3%, $300,000 mortgage. Your principal and interest payment is $1,264.81. Your servicer says a recast can make it $764.81. That is exactly $500 of monthly relief, $6,000 a year. And the administrative fee may be only $250. It sounds like an easy win. Slows down. But lowering this payment by $500 requires you to put approximately $108,370 into the mortgage today, not $5,000. Not $10,000, more than $108,000. The fee is almost irrelevant. The real transaction is this. You exchange a 6-figure liquid asset for additional home equity and $500 less required spending every month. That may improve your retirement. It may also cost you several years of portfolio spending. The answer depends on what happens to the same $108,370 after you choose where it lives. The mortgage mechanism is fairly clean. Your outstanding balance is around $269,570, with approximately 25 years remaining. You send the servicer the lump sum, reducing the balance to roughly $161,200. The servicer recalculates the payment across the years already left. Your 3% rate stays 3%. Your payoff date stays where it was. You do not receive a new 30-year loan. Fannie Mae's servicing guidance describes it as re-amortizing the current unpaid balance using the current interest rate and remaining loan term. Its Form 181 documents the new payment arrangement. So this is not refinancing with a friendlier name. One field moves, the balance. The lower balance is what creates the lower payment. And that distinction matters enormously in 2026. Freddie Mac reported an average 30-year fixed rate of 6.30% on April 30th. On August 13th, it was 6.67%. Those are broad market averages, not quotes for every borrower, but replacing your 3% mortgage around those levels would be a very different transaction. Refinancing is not universally dead. A borrower with a high existing rate, a shorter replacement term, or another specific objective may still have a case. You do not have that case here. You already own unusually cheap fixed debt, and a recast lets you lower the required payment without surrendering it. That makes the recast operationally attractive. Oddly, the same low rate is also what makes the wealth case for paying down the principal weaker. First, though, fix one phrase that causes a lot of bad mortgage math. Your $108,370 does not disappear when you recast. Your cash falls by that amount, but your home equity rises by roughly the same amount. Your net worth does not collapse on the day of the transfer. Its location changes. Before the recast, the money can sit in treasury bills, an index fund, a bank account, or whatever asset fits your plan. You can use it for a job interruption, a roof, healthcare, or a move. After the recast, it is committed to the house. Accessing it generally requires selling the home or borrowing against it. That is the first scorecard change. Liquid assets fall by $108,370. Mortgage debt falls by the same amount. The required payment falls by $500. The return from avoiding mortgage interest is guaranteed at roughly 3% before tax considerations. Flexibility declines because equity is not spendable cash. Now follow the money down 3 paths. In path A, you recast and use the $500 as spending relief. Your monthly budget improves immediately. Maybe property insurance has climbed. Maybe you are reducing work. Maybe the old payment was interfering with retirement contributions or leaving too little margin after taxes and maintenance. $500 of lower required spending is valuable. It is not income, though. The house is not sending you a check. You have prepaid enough principal that the servicer now demands less from you each month. If you spend that difference, your life becomes more comfortable. But no replacement investment appears on the balance sheet. You hold more equity, less cash, and a smaller mandatory payment. That can be a rational combination. It is also the combination that produces the largest compounding opportunity cost. By the way, if this kind of balance sheet math is useful, subscribing to Lazy Investor helps the channel a great deal. I appreciate everyone who does. Path B keeps the original mortgage and invests the $108,370. The payment remains $1,264.81, so you must be able to carry it without creating a different problem. Morningstar's broad United States market data showed a trailing 10-year annualized total return of 13.57% as of August 13th. 2026 with distributions reinvested. If that exact historical rate continued, the lump sum would grow to approximately $387,000 after 10 years and $731,000 after 15. With restrained disbelief, yes, that is a large number. It is also backward-looking history, not a return forecast. Using it as a projection would make Path B look almost embarrassingly obvious. Markets do not sign amortization schedules. A 3% interest saving is contractual. A stock return arrives unevenly, may be negative when you need the money, and can create taxes and fund costs depending on the account. The historical illustration still performs one useful job. It shows the scale of the opportunity you transfer into the house. Once the principal payment is made, that exact lump sum no longer participates in market compounding. But comparing a $387,000 portfolio with $150,000 of avoided payments would be nonsense. The dates do not match, the mortgage balances are missing, and lower payments are being confused with assets. At the 10-year mark, Path A still has about $111,000 of mortgage debt. Path B has about $187,000. So Path B carries roughly $76,000 more debt. Subtract that debt disadvantage from the historical portfolio. Path B's approximate net balance sheet lead is then $310,000, not $387,000. At 15 years, Path A owes around $79,000. Path B owes around $135,000. After accounting for that $56,000 debt difference, the historical portfolio illustration leaves Path B ahead by about $675,000. That calculation assumes Path A spends the monthly savings. It also excludes taxes, fund expenses, any mortgage interest deduction, and the costs of accessing home equity. More important, it assumes a future return equal to an unusually strong trailing period. So the useful answer comes from lowering the return dial. At a 5% annual portfolio return, the lump sum grows to about $177,000 after 10 years and $225,000 after 15. After correcting for the additional mortgage debt, Path B leads by approximately $100,000 at 10 years and $169,000 at 15. At 7%, the corresponding lead is about $137,000 after 10 years and $243,000 after 15. Suppose your retirement plan requires $60,000 a year of portfolio-funded spending before tax. The 15-year advantage at 5% equals roughly 2.8 years of that spending. At 7%, it equals about 4 years. Those are spending equivalents, not promises that retirement lasts exactly that much longer. Actual withdrawals, face taxes, market sequence, inflation, and personal spending changes. But now the title has a denominator. A comfortable $500 reduction can exchange away capital representing several years of a $60,000 annual portfolio requirement. The mathematical threshold starts near your mortgage rate. If an alternative asset earns 3% after relevant taxes and costs, its result should be close to the guaranteed interest avoided by paying down 3% debt when cash flows are treated equally. Risk changes the preference around that line. A guaranteed 3% and an uncertain 5% are not interchangeable merely because 5 is larger. Your mortgage interest deduction, if you receive one, can lower the effective cost of the debt. Taxes on investment returns can lower the portfolio result. Neither adjustment automatically wins the argument. The Bureau of Labor Statistics reported that consumer prices were 3.4% higher in July 2026 than a year earlier. Inflation does not make your mortgage profitable. It means a fixed nominal payment may become less burdensome relative to future prices and income. Paying off cheap fixed debt early also gives up that potential erosion of the debt's real weight. Path C isolates a different choice. You send the same $108,370 to principal, but you do not recast. You continue paying $1,264 $2,258.81. The principal transfer is identical to Path A. The behavioral instruction is different. Because the required payment never falls, more of every later payment attacks principal. In this illustration, the remaining mortgage disappears in roughly 12 years and 10 months instead of 25 years. You save approximately $35,000 more future interest than the recast and lower payment path. So paying principal creates the interest saving. Keeping the original payment creates the early payoff. The recast itself creates neither of those benefits. It converts part of the accelerated payoff into present cash flow relief. Path C is attractive when your objective is reaching retirement without a mortgage and the current payment remains comfortable. It is weak on liquidity because the lump sum is still locked in the house and it provides no immediate budget relief. You receive certainty and an earlier finish line in exchange for both the cash and the monthly flexibility. Up to this point, expected ending wealth has been doing most of the talking. Retirement changes the job. More seriously, remove employment income from the household. Path B may have the largest expected liquid portfolio, but it also requires $500 more every month. Path A has fewer liquid assets, yet its required principal and interest payment is $6,000 lower each year. If a weak market arrives early in retirement, that smaller obligation may reduce how much you must sell from the portfolio at depressed prices. If part-time income becomes necessary, it lowers the amount that work needs to cover. If you are trying to qualify for retirement with a narrow monthly margin, lowering fixed expenses can make the plan more resilient even when it does not maximize expected net worth. This was never only a contest between a 3% mortgage and an index return. It is a trade between liquid reserves and mandatory burn. The recast fails as a retirement risk strategy if it consumes the emergency reserve that was supposed to prevent forced selling. You cannot celebrate a safer monthly payment after leaving yourself unable to cover insurance, taxes, maintenance, or a major repair. Those obligations do not get recast. Escrow can still rise, and the $764 figure covers principal and interest, not the complete cost of owning the home. The lower payment earns genuine option value when substantial liquidity remains after the transfer. The amount needed is household specific, but the principal is not. Home equity should not be asked to serve simultaneously as your payment reduction tool and your accessible emergency fund. There is a behavioral modification to Path A. You recast, then automatically invest the $500 every month. That rebuilds liquid wealth and preserves the option to stop the contribution during a difficult period. It is far stronger than recasting and allowing the monthly difference to dissolve into ordinary spending. It does not recreate the original lump sum's time in the market. At an illustrative 10% annual return, investing $500 monthly for 10 years produces around $102,000. Investing the $108,370 immediately at the same rate produces about $281,000. The gap exists because most monthly contributions arrive years later. The final $500 deposit receives almost no compounding time. The lump sum receives the full decade. After adjusting for Path B's higher mortgage balance, investing the lump sum still leads the recast and invest strategy by roughly $102,000 at that 10-year date. At returns near 3%, the two approaches come much closer because the investment return and mortgage costs nearly offset. Automation therefore improves Path A without changing the timing physics. If investing the $500 is your stated reason for recasting, the automatic transfer needs to begin with the lower payment. I will invest the difference is not an asset. A funded account is. None of this matters if the loan cannot be recast. Conventional conforming mortgages are the primary territory. Federal Housing Administration, Veterans Affairs, and Department of Agriculture loans are generally ineligible. Jumbo and portfolio loans depend on the investor and servicer. Policies vary even among large servicers. Chase says it has no required minimum and currently describes its recast as having no fee. Rocket Mortgage states that it requires at least $10,000 of principal reduction within its qualifying window and charges $250. Mr. Cooper lists a $10,000 minimum, a fee of up to $250 where permitted, and processing that can take as long as 90 days. Those are representative policies, not universal rules. A recently transferred loan may face a waiting period. The mortgage may need to be current. Some servicers allow prior extra principal payments to count, while others want the curtailment handled through a specific process. The operational gate is one call: whether your specific loan is eligible, how much principal reduction qualifies, what the fee is, when the new payment begins, and whether earlier curtailments count. Until you have those answers in writing, the $764 payment is an estimate. The final classification follows from consequences rather than a universal winner. If the existing payment is affordable, retirement is many years away, you retain adequate risk capacity, and your objective is maximum expected liquid wealth, Path B usually wins under the 5% and 7% assumptions. You preserve access to the capital and give it a chance to compound above the 3% mortgage cost. If your objective is eliminating the mortgage sooner, Path C gives the principal payment its full force. You accept the old monthly obligation and finish roughly 12 years earlier in this illustration. If retirement is close, reducing mandatory spending materially protects the plan and plenty of liquid reserves remain afterward, Path A can be rational. You are purchasing a smaller, fixed obligation. You are not claiming the highest expected balance. And if the lower payment is meant to rebuild investments, automation determines whether that explanation becomes real behavior. A quick note before the final decision. Subscribing helps lazy investor keep doing this kind of housing math, and I'm grateful to the people who choose to do it. There is a mildly annoying inversion here. Your 3% mortgage makes recasting more tempting because refinancing around 2026 market rates is unattractive. Yet that same 3% rate makes surrendering liquid capital less compelling as an expected wealth decision. Cheap debt is valuable when you can carry it safely. A lower fixed burn is valuable when cash flow, rather than expected return, is the constraint. The spreadsheet cannot choose between those objectives because they solve different retirement problems. Look, comfort is allowed. Owning your home with a smaller required payment can provide stability that an index balance cannot provide. The house shelters you, and that benefit is real. A portfolio provides liquidity, diversification, and spendable resources that home equity does not provide without another transaction. Do not count shelter as investment return. Do not count equity as cash. Do not call avoided outflow income. And do not treat the highest expected balance as automatically safer when reaching it requires a payment your retirement budget cannot reliably support. The decision reverses when any major condition changes. A higher mortgage rate strengthens the value of principal reduction. A shorter investment horizon weakens the compounding case. Inadequate liquidity can disqualify the recast. An unaffordable payment can disqualify keeping the original loan even when its expected wealth result looks better. For the household we started with, the payment is affordable, the mortgage rate is 3%, the horizon is 15 years, and the goal is maximizing retirement wealth. Under those assumptions, spending $108,370 to reduce the payment is the losing trade. At a 5% portfolio assumption, its matched debt opportunity cost is approximately $169,000 after 15 years. At 7%, it is about $243,000. Against a $60,000 annual portfolio spending requirement, that represents roughly 2.8 to 4 years of spending capacity before tax. If the household instead needs $6,000 less mandatory spending each year to retire safely, the ranking can reverse. The smaller payment may reduce forced withdrawals, preserve a cash flow margin, and make the plan livable. That benefit should be named honestly because it is risk reduction, not superior compounding. The house is either a wealth decision or a lifestyle decision, pretending it's both, is how the math breaks. Quietly, deliberate, a recast does not create $500. It tells you the price of removing $500 from your required monthly payment, and here that price is $108,370 of liquidity and everything that money could have become. A lower payment can improve your month while weakening your decade. The mortgage statement cannot tell you which one you bought.